Good evening, everyone, and welcome to tonight's webinar with Catalyze You. My name is Anthea Hotzenberg, and I'm very excited for tonight's conversation. I head up platform and community here at Catalyze You, and I will always also be your host for this evening. If this is the first time you're joining one of our webinars, welcome. We're really glad to have you. I think you're in for a really exciting conversation this evening. Before we move on, I'll be admitting people as they come in. I do request that once you have joined to please mute yourself, just so that we don't have any interruptions for any of our other people that's joining. But on that note, this is what you're in for this evening. We are doing a conversation tonight on due diligence and navigating it, especially during the funding rounds with VCs. And this is for founders and those interested in the VC space alike. And I'm very excited for the panel that will be joining us tonight. Brian Misondo, who's an investment manager, already on the call. Anthony Obidikwe, who's a solicitor, also going to bring quite an interesting legal perspective. And then Amanda Ituk, who's a co-founder. She'll be joining us a bit later. She's had an emergency this evening, but she'll be joining towards the end of the call. Right, so a couple of housekeeping things before we jump in. This is a Zoom call, which means you can unmute and speak. But for the duration of the event, we ask that you keep yourself on mute unless you are asking a question, which is the wonders of mute. So if you are, if you don't know how to do that, you can message my colleague Benji, who is on the call, and he'll be happy to help. In terms of how we'll run this evening, you have a choice. You can keep your video on or off. We will have our speakers spotlighted for you during the evening when they join a bit later. So feel free, video on or off. Always keep yourself on mute, as mentioned, unless you are asking a question. If you happen to drop off, feel free to join the meeting again, just using the link that's been provided, which is the same one that you've joined with tonight. If you have any technical issues, don't know where to find the mute button, being messaged by an AI, many of which are on the call, reach out to my colleague Benji, and he'd be very happy to help navigate that. And then if you need to drop off, a recording of this event will be available after tonight. I'll make sure that we get that to you immediately after this event. I'm looking on this side because I have two screens, and I'm also admitting people as they arrive. But on that note, I'm going to move on. So I've spoken a bit about housekeeping. What I do want to start off with, we have quite an interesting group of people joining tonight. Here at Catalyze You, we believe in the value of network. And if you've watched the video that we opened up with, we have quite a big network across the VC space in Africa and beyond. So if you are new to our webinars, I invite you to connect with the people on the call tonight. And you can do that simply by dropping your LinkedIn link into the chat, and people can connect with you during the event and after. Let's start by doing that. So for those on the call, please tell us where you are from. So just drop it into the chat, which city you're dialing in from and which country. That would be great. I also have quite a few people from our courses on the call, so I'm going to be calling on some of them to introduce themselves. Let's maybe start with Letu. Hello, Letu. Do you want to tell us a bit about who you are and where you're joining us from?
Hey there, guys. My name is Letu Luchabe. I'm from Port Elizabeth. I'm a master's student in human settlement development, and I'm huge on data science and VC.
And Letu, you are also part of our current, our most recent cohort, right? Do you want to tell us a bit about the program that you did?
Where do I start? It was life-changing. It was a new experience for me. I don't come from the VC industry traditionally, but I have links to it through my startup, and I've always been interested in just wanting to know more on the other side of VC, and this course was just an eye opener.
Awesome. I really love hearing that, Letu, and thanks so much for joining this evening. Let's do two more. How about Tatu Malelu? Tatu, do you want to hop on and tell us where you're joining from and give us a brief introduction?
Hi, everyone. So I'm Tato. Nice to meet you all. I'm joining in from Johannesburg, South Africa. I'm currently a strategy consultant who really has a keen interest into the VC space and the ecosystem. Hence why I've joined the webinar tonight, and I've been following Catalyze You for a year or two now. And I'm really keen to learn more, and hopefully I'll be signing up for courses within the next couple of months. Nice to meet you all. Sorry I couldn't put on my camera. Thank you.
All good. Nice to have you, Tato. Finally, let's say hi to Simon Muriti. Simon, do you want to quickly introduce yourself? Tell us where you're joining from.
Hi team, my name is Simon Muridi. I represent Nairobi, Kenya, one of the Africa Silicon Savannah, and I'm very, very excited. It's my first time to join your meeting, so I'm looking forward to enriching in my mind, learning new tips and tricks, and having a good time. Thank you.
Fantastic. Great. Thanks to everyone who joined in. For everyone that I didn't call on, please feel free to drop your LinkedIn profile in the chat. Hello to Shui Zhang from Atlanta in the US. Hi to Cynthia or Winky. Hey to James from Beeline, which is our tech partner for our courses, and everyone else that's on the call. It's really nice to have you all here. Let me just submit one of two more people. Right. So let's quickly talk about how session. Very soon, I'm going to call on our speakers onto the stage. It will be Anthony and Brian. They will be joining for most of the conversation, and then Amanda will join towards the end of the call for her part as well. You can drop questions throughout the evening directly into the chat. I'll be taking those as we continue with the conversation. So please drop those, anything related to VC investing, due diligence, the due diligence stages, the different kinds of due diligence. We are here to answer all of that. And if we don't get to it with the prepared questions, please feel free to get your question in there. And then I'll take it throughout the evening. Any questions we don't get to, we'll ask our speakers after the event to also do a response on that, and then we'll share it as part of our post-event communication. Finally, a quick word around Catalyze You and our upcoming programs. So you would have seen the intro video, but for those who joined a bit later, Catalyze You is a company that vets, trains, and places the best non-technical talent at VCs and startups across Africa and beyond. We have run two amazing programs to have a fantastic group of talented individuals, some of who are on the call tonight, and that has gone through our program and are now either pursuing careers in the venture capital or startup space, or planning to move into that space very soon. Our two flagship courses are the Catalyze You VC Fundamentals and the Catalyze You VC Advanced. Both of those courses are now open for applications. Applications close on the 4th of March, and my colleague Benji will soon drop a link to that application into the chat. So if you are interested, go and check that out. In terms of the conversation tonight, due diligence is a large part of the VC investment process, which means that's a large part of the courses or the programs that we offer here at Catalyze You. And we receive a ton of questions every time we run a cohort around this process, the ins and outs. We know there are a ton of lessons from startups who've gone through due diligence and either failed or gone through due diligence and succeeded at it, but later there were other red flags that were raised. We have enough of those examples. We're going to delve into some of them this evening as well. But tonight, really, the idea is, can we have a crash course, a masterclass on the high-level process around due diligence? What are the things that founders need to know? What are the things that investors need to know? And tonight, we have quite a good group of people who'll be adding their voices around that. On that note, I'm going to invite our speakers onto the stage, Brian and Anthony, and I will stop sharing my screen as they come and join me, and I will just also make you a spotlight for everyone. Just give me 1 sec. There we go. Hi, Brian, and then also Anthony. And let's start with a quick round of introductions. Brian, I'm going to start with you. Tell us who you are, where you're dialing in from, and why you are joining the conversation this evening.
Great, thanks, Cynthia. And thank you all for joining us today and having me. It's definitely an honor to be part of this great initiative. As Anthea has already mentioned, I'm Brian Masondo. I currently work as an investment manager at eSquared, based in Johannesburg, South Africa. And I've been with this organization, which focuses on impact investing and venture capital investing, for just over 8 months. But prior to that, I was at another VC called Naspers Foundry, where we had $100 million to invest in the SA ecosystem, of which we deployed $50 million before the fund was discontinued. And yeah, spent just somewhere between 2 and 3 years within Naspers Foundry executing some of the larger VC deals that probably been done in the past 4 years in South Africa. And before joining Naspers, I spent 5 years of my early career at Standard Bank, where I was in the investment banking M&A team. That was an incredible experience, and it was actually part of the reason that I decided to join venture and be where I am today. During Standard Bank, I worked on a number of transactions, right, for both advising clients that are both listed and unlisted, and we're talking deal sizes of anywhere between, I was speaking rands, anywhere between, let's call it 500 million rand all the way up to 8 billion rand. And I also help set up a team that focuses on providing corporate finance and capital raising type advisory services to what they call their mid-market slash commercial banking clients. And those are clients that generate revenues of anywhere between 100 million rand to 1 billion rand. And yeah, that's me in a nutshell.
Awesome. Thanks, Brian. Good to have you. Anthony.
Yeah, thank you very much, Anthea. My name is Anthony. I am a lawyer from Nigeria. I work with detailed commercial solicitors, where most of our work cuts across finance advisory, different kinds of finance, from project finance, private equity, startup investments, and things around that. I particularly, decided to jump on this call because when Catalyze You reached out to me on the topic, I felt it was a topic that, is very fundamental to, investments. It's one that startup founders need to, they need to have as much knowledge about, because it basically decides on whether an investor would go ahead with the financing or not. So, Anthea, I'm good to be here, and I hope to have a fantastic time this evening. Thank you.
Fantastic. Nice to have you both here. As mentioned to everyone on the call, Amanda, our third speaker, will be joining a bit later. But for now, we're going to jump right in. So let's kick off. Typically, a VC investment process involves a couple of steps, right? Initial screening, maybe a pitch meeting, an evaluation of the business model and market, and then, where funds conduct an in-depth analysis of the startup's business model, looking at market size, target audience, and so forth. After this, if the opportunity is validated and in line with the fund's investment thesis, we usually move on to due diligence. Sorry, Lucia, I'm just going to mute you. Thank you. After that initial few steps, we usually move on to the due diligence process, which is what we are here to talk about. Brian, I'm going to kick off with you. Can you provide some insights into the typical stages and key milestones of the VC due diligence process, just to set the stage for us this evening?
I'd say if you look at how different investors and different venture capital firms and funds operate, they'll vary across the board, right? But I'd say in principle, one can expect 3 stages, which is pretty standard, right? The first being an detailed information request list. I know that most founders, as they're raising capital, they'll obviously provide access to a VDR. Some do it different, and the normal way in which this is done is all the files that are in the VDR are normally shared and are made available upfront. But you do get some founders that, depending on the sensitivities of the business and opportunity they're building, they prefer sharing information in stages, right? So if they feel that they're less comfortable to share everything upfront, like contracts with potential key suppliers, if it's a B2B play, what they'll normally do is they'll share marketing materials upfront, and then they'll provide an even broader data room once an investor has built up some conviction and is looking to take them more seriously and progress and progress the analytics and the assessment of the opportunity further, right? So the first stage is definitely related to information sharing and information requests coming through from investors. Then you have the second piece, which is what probably demands most of management's time, and this is I call this stage the engagement stage, right? At some point, you'll either be working with the investment team themselves. Sometimes investment firms will decide to appoint external service providers for various work streams. And during this stage, you'll either be working with the team, an external service provider, or both in unpacking your information, right? There'll be lots of information shared, be it from a financial perspective, technical perspective, or even discussions with customers. And you'll need to answer questions as they go through and sift through this information that's been requested. Then the final stage, which is super important and what probably determines whether an investor proceeds with making an investment or going to execute long forms or the legal agreements of a deal, is the feedback session, right? I think it's investors should share they should share feedback whether they decide to invest or not, or invest in a founder's business or not, right? And this is important for the ecosystem because one, if there were things that made an investor walk away, you want to give the founders an opportunity to correct and remedy those issues so that they can raise further capital from either the same investor at a later point in life or other investors that might not deem that as critical for them at the life stage of the specific business, right? So those are the three stages. So the first one is information. Yeah, there's like the information requesting and sharing stage. Second being the engagement stage, and then the feedback stage. Andy.
Brian, I want to ask an immediate follow-up on that. Where do you see most founders either, drop out or have the most difficulty with in terms of those three stages?
Good question, Andy. Look, it does vary. From my experience, I've probably done extensive DD on, let's call it 22 businesses in this in the VC space. And I'd say where things normally go wrong is in the first stage. What you generally find is that depending on how sophisticated the management team is that's running the business, some are building great businesses but are actually not good at, I guess, the housekeeping and storing of information isn't, and even like the reporting, right, isn't as great as it should be for the sorts of capital and the type of investor that they're raising from. So I think it's also a misalignment sometimes between founder and investor, where founders don't actually understand how the different types of investors within the ecosystem, like the depth to which they look at opportunities. And sometimes they'll see something great, but what they'll find under the hood is that the business and the business model probably makes sense and the traction is probably there, but in the way that the founder has been operating, the previous set of investors have given them so much leeway and rope to be, let's call it less corporate. I hate using the word corporate, but let's call it less formal and less corporate, and that can trip up deals on many occasions, right? If I'm an investor that wants to bring in, I don't know, a Deloitte, for example, to come and do an external financial and tax DD, and the information is just not there, or the founder is basically struggling to make themselves available for calls and other levels of engagement, that throws investors off, and some investors will actually walk away if that process is frustrating. So yeah, I'd say stage 1 and 2 generally.
Cheeky, but then should a first-time founder going through the due diligence process not feel too bad if they don't make a success of the first round, or are there actually ways that they could actually, going into it the first time around, make a success of it?
Good question. And yeah, and the right thing to do is when a venture capital firm, right, when a VC, when an entrepreneur is raising the sort of capital that warrants a detailed DD, what you'll generally find is that there are other investors that have been on the journey with them, right? It could be in the form of angels, or it could be in the form of other, let's call them financial investors that are willing to participate in the very early stages with limited DD or no DD, right? My suggestion is that if it's your first time going through that rigorous process where there'll be a detailed due diligence conducted on your business, best thing to do is to seek advice from those that have done it before, right? I'm pretty sure within the network of investors or even your personal network, you may know of one or two other founders that have been there, done that. Some have been successful at completing the full program and learn from them, right? I think that's the easiest and best place to start, right? Speak to any investor that backed you and has that formal, let's call it experience, or speak to other founders within your network that can share and, help prepare you better for that sort of work stream and engagement.
Fine. I think one of the biggest things that we learn constantly is founder education is important. Tapping into whether it's angel investors or any kind of, DFI, whatever the case may be, on the regular, and then also the value of network. If you have founders in your network, making sure that you tap into that. Anthony, I want to switch a little bit over to you, and I want to ask you from a legal perspective, where do you see startup founders, especially during the due diligence phase, either mess up or cause the process to be prolonged or actually just not benefit them in a specific way?
All right, thank you very much. So first, I would like to say that for most founders, especially for early stage founders, one of the fundamental problems I find with them is most times they may not really understand, the key implication of what a due diligence is and, the kind of impact it can have in a transaction, right? So probably, one of the most essential parts of the investment process because it sort of tells you, tells you the difference between what you think is and, what is actually the fact. Right. So in the course of due diligence process, like Brian rightly said, typically we always request for information, a checklist of the kind of information for legal due diligence, documents, different contracts, details of employees. We basically run through, we want to see the company as it is, the corporate structure, everything about the company. Now, most times startups or founders typically have issues or challenges in the documentation stage, being able to provide all the documents. And then at the point where they provide those documents, in the course of the due diligence, you find that there are certain what you call it now, certain criteria, certain requirements that they may not have at that particular time. It could be some sort of compliance challenge. It could be some sort of some issues around corporate structure. Discoveries that you'd find at the point of due diligence that makes progress sometimes slow or another times almost impossible, right? So now the kind of challenge or the kind of setback we'll find or red flag or flags we'll find it because of due diligence would to a large extent determine whether we advise our clients, in the case where our client is the lender or the investor, whether they would move ahead or whether we would place certain make certain demands of the startup. It could be those demands could be a condition precedent to the investment, or it could be some sort of maybe condition subsequent. So depending on the nature of the concerns we find, right? So most of the challenges and most of the setbacks we find will be around financial compliance, regulatory compliance. For the financials, financial diligence would typically cut across the numbers. That is where the auditors and the accounts guys come in. And then for us, the lawyers, who look at is the extent of financial obligation of the company, right? So when you look at the company and you analyze their financial obligations, you ask yourself, can this company accommodate this kind of investments? I mean, that's the fundamental question we get to ask ourselves in terms of the financials. So we oftentimes discover that, let's say for startups at the early stage, they would have issues with decision, but for startups that are more advanced, they would typically fall short, maybe in terms of the financial compliance, due diligence, or some sort of legal compliance and things around that area. So what we always do is we sort of itemize those challenges, those problems we've spotted, and then group them. So there are some that are complete red flags. We cannot be able to go ahead with this investment. There are other ones that the founders will be able to rectify, and those ones we would bring them, would inform them of those ones, especially things around let's say corporate issues, right? So if there are payments to be made, regular things to be regularized, we would, tell them to do all those. So that's basically where founders get to fall short as far as legal due diligence is concerned.
I think you touched on something important, which I think is worth clarifying for the audience, which is essentially that there are different levels or different types of due diligence. Anthony, do you want to talk us through what the legal due diligence process looks like? And then Brian, will hand over to you to talk through maybe, the legal and the technical elements. And then Brian will go over to you for the financial due diligence part of it.
All right, thank you very much. So the legal due diligence, when lawyers, especially when we're representing the investor, when we pick up a company and want to conduct due diligence, first thing we do is to send out a checklist, requests for certain information. We try as much as possible to comb through the company from top to bottom, right? We try not to leave any stone unturned. So in the course of due diligence, we'll look at the corporate structure of the company. We'll look at contracts, material contracts that the company has entered into, contracts with certain suppliers, contracts with certain third parties, right? To look at the financial information of the company. If it's a company that has certain assets, depending on the kind of services that the startup renders, we also look at the kind of assets, real assets, non-real assets, things around that area. We look at the claims and litigation claims against this company. What will be the impact of those claims, right? If a decision is made, the court holds a decision against this company, how can it potentially impact this investment, right? So we look at things around that area. We look at the intellectual property. Now, this is very, very vital because most times the intellectual property might be one of the most important, valuable assets of a startup company. So look at the ownership of the intellectual property. Is the company truly the owner of the intellectual property? Has it been registered? We look at issues around regulatory compliance, right? If you're a company in the tech, let's say fintech space, have you obtained the requisite license? Now, in this regard, I would like to place a small caveat, right? Because of my experience especially for startups, we've had instances where we have certain startups at the early stage who may not have certain licenses, right? That's not an automatic red flag. That may not be a reason to cancel the investment. Sometimes startups even want to obtain certain licenses to be able to offer certain products, right? So for licenses, it's something we look at, and we typically try to ensure that the startup obtains those licenses. Now, in terms of regulatory compliance as well, there are other aspects such as tax payment. I mean, those are typical red flags. You have to comply with your tax payment and issues around that before we can move forward. Then, of course, we look at your employment matters, your employees, right? Employment contracts. Now, startup founders that are inexperienced may overlook this, but this is a very critical part of due diligence. And why this is important in investment is, as wonderful as your products may be, your employees, especially the key management team, key individuals in the company, are so vital, because if you get to lose, if there are no proper setup and incentive to retain your best hands, or to retain those who make the products work, that could be a red flag. So that one of the things we look at is the nature of employment contracts. Are there employment issues, right? Things around employment, share options, and things around that. So basically, like I said earlier, when we look at some of these things, we create some sort of tab. So for this is an ultimate red flag. This can be worked on, and then this is something we can just rectify and then move along with it. So that is basically the structure of what a legal due diligence looks like. Yeah, thank you.
I want to follow up with one question, which is something that I think founders worry about a lot, which is essentially intellectual property, right? So keen to understand from you, what advice do you have for founders to protect their IP during the due diligence process, especially in countries where IP laws are, less established?
Okay, yeah. So one of the challenges or complaints we've had from founders, sometimes is there are certain founders, especially at the early stage, who get in touch with investors, and you're asking for certain information to be able to, what do you call it, to be able to, run your due diligence. Some founders may get a bit skeptical, they may get scared because um, this needs to apply more to maybe technical due diligence, where the investment company will want to have not just beyond legal aspects, where you get to see the documents as per intellectual property. In the technical aspect, you want to see the product. Does this product really work? You'd have to test the product and things around there. Yeah. So what we typically advise, startups to do in that instance, or founders to do, is where you're scared that, you might be exposing a lot in terms of your IP, ask for a non-disclosure agreement, right? Most investment firms, that are really professional will typically even issue an NDA before the process starts. So ask for a non-disclosure agreement. When you sign an NDA, that would, give more comfort to the founder, and they'll be able to release as much documents and provide as much information as possible. So that's one of the key ways you can, protect your IP in a due diligence process.
Thanks. Incredibly useful. Thanks, Anthony. I want to jump back to Brian here. So Brian, we've spoken about legal and technical due diligence. We've got a little bit about financial due diligence. I want to jump a little bit and speak about the specific due diligence considerations that vary across funding stages. Can you maybe tell us a bit more about that? And then also, how should founders approach it, especially in the early stages, going through this for the first time, perhaps?
Great, sure. So again, let me try simplify this by splitting the different stages into two buckets, right? I'd say the first stage is pre-Series A. So anything before Series, let's call it, before pre-Series A, I'd say would require a lighter DD, right? I think we've already touched on some of the key work streams that you'd expect in any due diligence process. I think Anthony covered them quite well. But yeah, finance is critical, right? What you typically see and find is some investors will do something as simple as reconciling the management accounts to the Fs. They'll verify and confirm that you actually do receive the income you say you receive from whoever your customers are. So they'll look at your bank statements, look at your invoices, depending on the type of business you have. They'll just try and get proof that you do have a willing buyer or seller that you transact with on the platform that's been built out, right? And this is linked to another critical DD workstream, which you should expect once your post-revenue, once your startup gets to a post-revenue stage. So there we're talking from seed onwards. Classic is commercial due diligence, right? And during this time, what you'd expect, the sort of work streams and sort of engagement you'd expect is anything where investors may want to maybe engage with your customers. I know for B2C businesses, this can be difficult, but it's important, right? We've seen a number of businesses raise hundreds of millions of dollars in developed markets, and they actually have no customers. But it's because this process wasn't conducted in the right way, right? So what you typically find is investors will ask you for a customer list, and they'll randomly select a customer, and they'll ask to have a quick call and a discussion with them to understand, right, if they get the value that you say you give to your customers, and is that being received and well received by your customers, right? And that will help inform your ability to get more customers and even improve your product, right? So you can expect, investors to request speaking to customers. It does become much easier if you have a B2B business, because B2B businesses are kind of built on relationships, right? But for B2C, it's also quite common for investors to make this request. Other two types of stakeholders that request to speak to are potential suppliers within your partners that your business has contract with. So commercial due diligence, super critical, and kind of talks to financial due diligence because it helps validate the numbers behind the numbers behind the startup that is being built up. Tax also very important and linked to Anthony's point, right? And what I've seen historically is that from a tax, the four biggest things, and Anthony mentioned them, is the employee tax, super important. Value-added tax and the treatment and how you account for that, very, very, very critical. Because, and then the last one is restructures. What we found, especially in the Africa ecosystem, is a number of startups may initially have a very conservative view in terms of how they plan on building their business and raising capital. And after realizing that they're onto something much bigger than what they'd initially thought, a lot of them start exploring and testing the idea of raising capital from international pools of capital, right? So we're talking the mega VC funds that are based in Europe as well as the US. And normally those funds will require they'll have requests, right? And some of these requests will be as simple as you need to be domiciled in a certain market to make it easier for them to provide capital into your business. And then it's at that point where you'll see things like IP transfers happening from within the ecosystem. And again, you just need to make sure that if you do transfer any IP or make those sort of redomiciliation type decisions, that you treat your tax in the, you go through the right process. And if there's any capital gains tax that needs to be considered or paid, something that you do need to seek advice from your connections and network to avoid running into trouble with authorities, because the penalties that come with those issues can be detrimental to the business.
Brian, I want to stay at this high level. How does the DD process at a very, very briefly and very high level, how does it different per investment type? So safe versus convertibles versus straight equity versus debt.
Question idea. So how we need to think of the different investment instruments is, again, let's link it to the life stage of an opportunity, right? So typically you'd expect to see safes and convertible notes at a stage where there's less certainty on things like valuation, right? And the reason there's less certainty on things like valuation is because your investors get that there's a huge opportunity here, but there's still a number of proof points that a business needs to get through to deliver the sort of execution that's required to be able to place any reliance on that future data or forward-looking data. So yeah, the type of DD that you expect at this super early stage where you were using instruments like safes and convertibles will definitely be much lighter than the type of DD that you'd expect in a stage where there'll be equity flowing or even debt, right? Because we all know how debt, especially in the traditional sense, when you're thinking of banks want things like collateral, banks want certainty, banks want to make sure that their money comes in when something has been significantly de-risked, right? So again, if you're thinking of raising traditional debt and pure equity, then the level of DD that comes with that is definitely more sophisticated and probably adds, it probably goes beyond the three that you'd always expect, which is finance, tax, and legal. That's when you'd expect to see things like HR, people DDing your human resources, right? The HR DD, commercial DD, in-depth technical DD, and other various DD work streams. So it's all about life stage, and that's what informs the instrument and the level of robustness of the due diligence.
Awesome. Thanks, Brian. Anthony, I want to bring you back in here before we jump into some blockers here in this process and how founders can navigate delayed timelines or extended timelines. A reminder to everyone, please, if you have any questions, just drop them directly into the chat. Anthony, I do want to talk about cross-border investments, especially in Africa. It's becoming more common, and obviously, as we have startups scaling and expanding their markets. From a legal standpoint, what should founders and I guess investors keep in mind when dealing with cross-border transactions and regulatory differences between countries?
All right, thank you very much, Anthea. Yes, so cross-border transactions are becoming quite recurrent now for so many reasons. One, we are currently having the investment winter. So one of the things that startups can do at this point, and which startups have started doing, is acquisition, right? So you can always acquire and move forward. So that happens a lot right now. So it's one of the easiest ways to expand into other jurisdictions. A couple of companies have done it in Africa. Now, when making that kind of move, of course, you have the acquiring company, you have the target company. That requires a high level of due diligence as well. So when you're looking at acquiring companies across Africa and cross-country transactions, you'd be considering issues around your taxes, you'd be considering issues your compliance, right? So when you're moving to acquire the country and the other jurisdiction, how compliant are they in terms of their licenses, their regulations, taxes, and things around that. So you find that you typically it should typically be the same kind of high level due diligence, right? But this time around, holding the highest standards. And then one of the things you also need to, consider is in terms of moving capital, right? So you have to consider moving capital issues around taxes. So that is more complicated than your regular financing. But what I would advise startups who are looking at going into cross-border or cross-country transactions is that is very different from your typical finance, your typical finance. So what I would advise is get as much professionals on board, find lawyers and professionals who understand, lawyers from your own end and lawyers, preferably lawyers from the target company for the target country as well. So make sure everything is on point, make sure everything is on check. That's just it basically. So for cross-country investments and transactions, it requires the same high level of due diligence with more strictness and deep compliance, cutting across everything I had mentioned initially.
Thank you, Anthony. We also have a question from the audience, which I'm going to direct to you as well. So Letu says, on the topic of NDAs, on 2 occasions, the responses from potential funders after asking for an NDA to be signed were not so great. Sounds like they were not keen. They were insulted and gave us the feeling that they were doing something we were not supposed to be. How should founders overcome this sort of hurdle with potential investors?
Okay, so what that question did not reveal is at what stage of the financing process they requested for the NDA, right? Now, I'll give you an illustration. I have had to work with a startup. I was representing a lender. I had to work with a startup. And at the initial stage, the investor asked for a pitch deck, right? And the startup founder requested for an NDA before releasing the pitch deck. Now, while there's nothing typically wrong with requesting for an NDA at that level, to be honest, these investors have a large chunk of portfolios and pitch decks they look at every day. I'm just being as practical as possible, right? So they have the large chunk of portfolios and pitch decks they look at every day. Most of them would really not have the patience to send you an NDA before looking at your pitch deck. For them, it's too early in the day, right? Now, but what I typically advise founders to do is, if you're uncomfortable, and what I'm saying is precisely regarding at the very early stage of contact, which is pitch level. So if as a founder you find that you're uncomfortable with releasing your pitch deck, you really want the whole due diligence and everything, the NDA and everything, what advice is a pitch deck. You don't have to provide as much information relating to the details of your day-to-day activities. What makes your product big, right? A pitch deck is supposed to give an investor a proper idea of what you're doing, a very summarized idea of what you're doing. And if you organize your pitch deck properly, you don't need to worry about what they would do with that kind of information, right? So provide enough information for the investor to be able to understand what it is your product is all about, what you're covering, what it's all about. But at the same time, ensure not to put anything in the deck that you would regret, putting in as well, right? Now that's for that early stage. Moving forward, when the conversation has moved from pitch deck to due diligence, right? And especially for heavy due diligence, there are certain due diligence you cannot conduct without even signing an NDA, because you have to the target company would have to release a lot of information. You have to send in a lot of documents, a lot of private documents, right? Now, when you do this, I really don't see any reason at that due diligence stage why an investor company would refuse to grant you this. From my experience, what I find is most investors have difficulty giving out an NDA at the very, very early stage. But when conversations get serious, they would typically want to sign an NDA because we're releasing a lot of private documents, right? And one other thing that of course, as a founder, when your product, what we always advise clients to do is always get your IP registered, right? Have it registered. That way you have a certain level of comfort onto yourself. You don't get to worry about things like that. So, well, this is from my experience how it typically happens. Founders founders always have issues. Investors always have issues signing NDAs at a very early stage. However, deep down into the conversations, that shouldn't be a problem. But thankfully, we have Brian here. So can you tell us why they find it difficult signing NDAs? Because this has been an issue as well.
Brian, on the spot, love to hear your take.
Thank you. Yeah, Anthony, I think you summarized it so nicely. And there's two ways to look at this, to answer this question. The first one is, I agree with Anthony, right? Put yourself in the VC's shoes. You're probably meeting more than 200 founders a year. Like most VCs, they're meeting somewhere north of 150, 200 founders during the course of the year. And a lot of these, I guess, these requests for funding or requests for someone to invest in a business is unsolicited, right? It's inbounds that come through LinkedIn, they come through connections, they come through just cold email. And if I'm not the one hunting in my network hasn't told me that there's a great business, you have to go look at them, I won't be as under pressure to sign an NDA if it just comes out of the blue, right? So the bargaining power is also determined by how well you've executed as an entrepreneur. The earlier you are, the more difficult it is to get some VCs to sign NDAs. But once you prove yourself and you've got like a great PR story and you're raising, your story is quite available in the public domain, then I think there's also a willingness on our side to hear you out as the founder and sign NDAs. Then the second piece that needs to be understood and needs to be made clear is that some NDAs actually make it hard for VCs to look at other similar businesses in the future, because then there's a founder could build an argument around, you took the knowledge you learned from my business and shared it with this business, and that's why they're operating in a certain way, right? So what's actually happened in the market is a number of VCs have in-house NDAs that they're willing to share with entrepreneurs. And if entrepreneurs are comfortable with the terms and the drafting of the legal, of the legal wording that's been used to cover each party on different aspects, sometimes you'll sign an NDA, but that's been shared by the VC as opposed to the entrepreneur. So yeah, that's my contribution on this point.
Very, very useful. It depends on the stage. It's the balance of power. It's also useful to understand that, whether you're approaching the VC or they're approaching you, what is the story you're telling? We don't have a lot of time left, so the next few questions is going to be rapid fire. I'm going to ask both of you to keep your responses very brief. Let's start with, in your view, what are in what stage do you see the most hurdle founders, especially in like a protracted timeline, and what advice do you have for them to navigate that? Let's start with Brian, reverse order.
Okay, so the question is, where do things go wrong? Sorry, and how do we avoid it?
During the due diligence process, what stage do you usually see, timelines to be protracted or extended, and what advice do you have for founders to deal with that?
Okay, I'll try to keep this as short as possible. The first one is getting founders to answer some questions in the DD findings, right? So as we've already mentioned, a lot of information gets digested, and sometimes investors struggle to make sense of this information. It's in the founder's best interest to respond as soon as possible and in as much detail as they possibly can to make sure that the investors can, get their investment thesis built up in the background in a timely and comprehensive manner, to avoid them being scared or worried that they don't understand your business well, right? So yeah, just make yourself available. Once you in a DD phase, tell yourself that you're going to focus and devote as much time as possible to dealing with investors to make sure that that part of the process doesn't trip up the investment decision-making process.
Yeah, fundraising can be a full-time job. Thanks, Brian. Anthony, from your side, any insights?
Yeah, so basically, the due diligence process, like I said, is a very, very unique process. Here in my firm, we allocate a timeline of 2 weeks to start and complete a due diligence, right? Now, the 2 weeks is subject to the founder providing the requisite information timelessly. So we create a virtual data room where you have to provide all the information we require. Now, one of the challenges, like I earlier mentioned, or one of the areas where founders typically have challenges is, having this sort of information we need, right? So if you're able to provide all the information we need as soon as possible, if it's documents you have, or if it's an area you have an information, tell us, oh yes, we have this. If you don't have this, tell us, oh, we don't have this, or we're working at this. Just give us progress, right? So information gathering happens to be one of the typical stages. If you have lawyers who represent you and know exactly what they're doing, like I said, in our firm, our target is typically 2 weeks, and we almost always stick to that, except of course where there are delays on the part of the founder. Then another thing I find to be very critical is communication, right? It's so important to keep an open line, communicate as much as possible. If there are challenges you're facing, communicate with your investor. And why is this very important? Investors are human beings, right? When you communicate to them properly, one, it even gets to, you create a relationship with them, right? They get to understand. Now, one advice I'll give to founders is, if you're a founder and you know you're not very good at communicating, or you may not be able to keep up with, the due diligence process, get someone in your organization who is very good at this, who will keep up with the lawyers, keep up with all the professionals, the VCs, keep up with all of them, right? And someone who will maintain all the relationship, manage all the interface and communication, right? So I think if founders implement this, it's a way long way. So have all your data ready, have them complete, and please, as much as possible, communicate. Thank you.
Thanks, Anthony. We are fast running out of time, so I'm going to lob my final question to both of you. I think a large part of the conversation around due diligence, certainly from last year, came about when we saw a number of high-profile startups in the failing in the ecosystem. A notable one being Dash. And what happened thereafter was, people were saying there were some missed red flags from investors, and then probably some knee-jerk reactions in terms of how do we handle that coming into 2024. So I want to end off with your thoughts very briefly again. How do you foresee the due diligence process evolving in 2024 and beyond? And what are the important things that will be driving that beyond what we've seen in 2023? So how is the process going to evolve in 2024, and what are the factors that will drive this change? Let's start with Anthony, and then we'll finish off with Brian.
Yeah, Anthony, it's sadly you had to mention Dash. Well, the Dash story is a very sad story because there was a lot of promise around Dash, but sadly there were issues around their numbers, their financials not matching what they claim it is. Remember what I said? The due diligence process helps you sieve out the claims from what is actual, right? So I'm really curious to know how, what happened in the due diligence process and how that was missed, right? I mean, aside the allegations of financial mismanagement and all that. So what this has done is it has automatically made, the ecosystem and due diligence process more strict, right? Investors are more careful, lawyers are more careful, right? Because nothing can go wrong. I mean, Dash had over 32 million, 32 million investments in Dash, right? So, and that's all went away. So what this has done is already there is a funding winter, right? So which means that startups are more focused on profitability over growth. Now, if you focus on profitability, a lot has to do with your numbers. Now, your numbers have to be right. Your documents have to be right. It's just more strict due diligence, especially aside the legal aspect, but especially in terms of the accounting and the audits, because everything just has to be right. Yeah. So basically, it creates a more strict due diligence compliance, due diligence procedure. Yeah. Thank you, Anthea.
Thanks, Anthony. Brian, take us away.
Thanks, Anthea. Yeah, I fully agree with Anthony. I do think the type of due diligence, or the different types of due diligence, will intensify even more now, right? Where historically things were being done by internal teams, funds that can afford to appoint external service providers to take an even deeper look will go that route, right? And it's important for the ecosystem, because what we need to make sure that the capital that we invest as investors, which belongs to LPs, right? It's actually not our money. It's much broader institutions that have pension funds, family offices. There's different types of capital that we act on behalf of. We need to make sure that we deploy that in a responsible manner, right? So I think there'll definitely be pressure from LPs that these sort of mistakes don't happen going forward. And the only way you stop them from happening is just intensifying the type of due diligence when you look at opportunities.
Brian, Anthony, thank you so much. I'm going to end tonight's conversation. This was fascinating. I think there was a lot of really useful insights shared, and we will be making this recording available to everyone. I want to thank our speakers. I think there's so much that we can still continue to unpack here, and so we might another session around this. But thank you so much to everyone that's joined. Thank you to our speakers. A reminder that you can cover and learn more about the due diligence process during our upcoming cohorts, fundamentals and advanced. I will share all of that information in the post-event email, including the links to our speakers' LinkedIn profiles. Please go and connect with them. If you have any other questions, pop them through to me. I'll get Anthony and also Brian to have a look at it. But for that, thank you very much. Thank you for the conversation. Thanks for offering up your time, speakers. Go and have a good evening, and I'll see you at the next webinar.
Thank you.
Bye, everyone.
Okay, bye.